Hi, James here, your tax expert online, coming back to you with the final video in the series on cryptocurrency taxation issues in the U.S. Taking this quickly in a hotel lobby here in Houston. So I just wanted to come back and mention, some of the issues that we would consider in preparing the return, as well as looking forward. The looking forward part may have a lot to do with in 2018 and in the future. We have to consider whether or not your activities may give rise to the potential for estimated tax payments. We are definitely of the opinion that you should pay not only the least amount of tax possible, but as late as possible. And so we want to avoid having penalties. But we do not advocate, having some sort of significant overpayment in order to, cover yourself. As I said in an earlier video, we certainly don't have any concern about the government being concerned about whether we're paying enough in. We want to pay the least amount of tax possible. So that's what we're here to help you do. But we need information as we go forward to be able to put you in the best position so that you can pay the least tax possible as late as possible, without incurring penalties. So one of the things that we have to consider is that adjusted tax basis, because I really didn't address it directly in the earlier videos, but when you make a sale or exchange of your cryptocurrency, how do you know which, if you bought it several times and then you make an exchange, well, which ones did you exchange? How do you identify the ones? Because they all cost you a different amount. And so we have various methods, accounting methods that are allowed to us in preparing your tax return. And we want to select the best method for you. And while there are some general statements that could be made, the individual circumstances that you face are the ones that actually are the only ones that matter on your own tax return. So the two principal methods that we would consider are called, under their acronyms, FIFO and LIFO. You may have heard these just from an accounting standpoint before, if you've had any exposure to that. FIFO means first in, first out, meaning that the first items exchanged would be the first ones that were purchased by you, just sort of an ordering rule. LIFO is the other one, meaning the opposite, the last in, first out. In a period of rising prices, to lower the amount of the gain, typically one would consider the LIFO method as being the one that saves taxes, because you are selecting the units, the highest price that you paid, and measuring your gain or loss using that adjusted tax basis. So you'd be better off from a perspective of reporting the least gain possible. But even in individual circumstances, the least gain might not always be according to your objectives. There may be situations where you are wanting to put as much income in 2017, for example, versus what you expect to happen in 2018, and so you might want to trigger a larger gain. So we would take that into account. We'd also take into account one of the other potential benefits of LIFO is that as long as you don't do a complete sale of everything that you own by the end of the year, then the earlier ones that are still treated as left in your portfolio are still counting toward that 1 year mark. Or you may have acquired them, more than 1 year ago already. And as long as we leave those intact, then when ultimately they're sold, you're eligible for the long-term capital gain tax preferential treatment. But there are many other things to consider, and once we make a decision, it's difficult to try to make a change to the accounting method. So we want to take into account all the circumstances that would help us there. On the mining side, I mentioned, the Section 179 election. There are other types of depreciation, particularly if you don't make that election. Then there are bonus depreciation methods and all manner of particular depreciation points that we can take into consideration. We mentioned before about Section 1031. It could be that that you feel that you wish to take that position, and then we would have to consider the disclosure statement, the inclusion of disclosure statement for that, and then there are also the other possibility is that there are other businesses involved, other activities involved. If you have had this, you're probably aware of what I'm talking about, but there are such things as passive activity losses. We often see this in real estate, where you're not actively involved in the management of the real estate that is generating income or loss for you. And if it generated a loss, that loss is restricted, it's suspended, but it is an indefinite period of existence, so that means it doesn't ever expire. It can be used against future passive activity income, or when you dispose of the asset that gave rise to the loss, then the loss is triggered. You might have suspended passive activity losses, and so if you are in that classification of owning a mining rig, but you're not involved at all in the actual management of it, you simply receive, almost as a passive investor, the income from it, then we would consider that as being passive activity income. The passive activity income would then be sheltered by the passive activity losses that you had from other activities, and thus the income would ultimately not actually create a tax liability for you. So that would be another thing that we would consider in our planning process. So we need to know your whole picture in order to be most effective for you, in order to ensure that you have the least tax liability. So legal entity structuring with respect to the mining activity, perhaps with respect to your investment activities, would also be a part of what we would want to consider. And again, if you have other business interests, this should be done holistically, not in pieces. And so one advisor really should be involved in managing, what the legal entity structure is for all of your businesses. We found that a lot of people who are doing work, even CPAs or enrolled agents that you might have as advisors, have really been very focused on getting the compliance done, and there really hasn't been any actual tax planning done. So I think what we would say is this might be the right opportunity for you to take into account tax planning overall, the adoption of tax strategies that will help you going forward, and we can get it started with your 2017 return. So, all right, so that's going to wrap it up. This is James Crenshaw signing off, your tax expert online, and we will make sure that you know how to reach us. And we're able to talk to you about providing services that will be of benefit to you. Thank you. Bye-bye.